All right, well, happy Thursday to everyone, and I hope you're all having a great summer. As you can see, I'm on the webcast with my colleagues, Matt and Nick. We're thrilled that all of you could take time from your busy summer and vacation schedules to spend a little time with us for our webcast. Once again, we always try to keep these to 30 minutes, and I'm sure we'll be able to do our best to do that today. This is being recorded during the summer months. Obviously, it's a challenge with people's schedule, and so we're recording this. So for those clients that are not available to participate today, we're going to send out a private YouTube link, and we'll send it to you as well. So I'm going to turn it over to Nick and Matt now. We're going to go through the webcast, and then I'm going to come back at the end to talk about some of the developments at the firm in the second quarter and action items for the next 2 quarters. So Nick, I'll turn it over to you now.
Great, thanks, Kurt. So we're going to start off, as we do customarily, with the second quarter review. The market backdrop in the second quarter contained a majority of positive news. Businesses continued to open around the United States, and the COVID-19 distributions continued. The U.S. jumped to the top of the Bloomberg COVID-19 resilience ranking. This ranking ranks all the countries based on several metrics, including number of people covered by the vaccine, lockdown severity, flight capacity, and vaccinated travel routes. On the more cautious side, the Delta variant is increasingly taking over headline news. On a personal note, I drove up to New York from Florida this summer, and at every stop, from the beaches to the highway rest stops, I was met with the types of crowds I was used to pre-COVID. So from what I could see at least on the East Coast, things are back open. Yesterday, Federal Reserve Chairman Jerome Powell pledged powerful support to complete the U.S. economic recovery from the coronavirus pandemic. He also stated that his confidence that recent spikes in inflation were expected after the pandemic lockdowns, and he expects inflation to fade over time. This is going to be a topic we're going to touch on several times here during this presentation. This consistent accommodative stance has helped the markets recover from bouts of volatility during the second quarter, and I'll point one of those out on the following charts. The Federal Reserve continues to closely monitor the unemployment rate. It finally dropped under 6% during the quarter, after almost reaching 15% during the pandemic. Another tailwind for the markets has been the progress made with the infrastructure bill that is pending congressional approval. Every time that takes a step towards being approved, the markets seem to react positively to the news. Looking at the public markets, equities continue to surge. They had a great quarter. This was driven mostly by large cap US growth stocks. Those US growth stocks are the same ones that have kind of taken a back seat here in the last few months, a couple quarters, but it seems like when interest rates fall, large cap growth companies tend to do well, and that's what happened in the quarter. The interest rates falling also helped core fixed income to bounce back a little bit from what has been a kind of a tough year for core fixed income securities. Looking at the actual numbers, I'm going to focus here on the third column first, the 2Q 2021 numbers. So global equities, as I mentioned, were up very strong during the quarter, up 7.4%. You can see the red highlighted box there, driven by US large cap growth, which outpaced kind of the rest of the indices. But if you look at these other indices, whether it was value or international markets, all up over 5%, which, on any quarter, that's a very strong return for those markets. Global equities are now positive for the year of 12.3%. I'm now in the year-to-date column. And this has been driven for this whole 6-month period from US small cap stocks and predominantly US large cap value. Commodities and public real estate have had a nice bounce back after kind of a tough 2020. Both are up close to 20% for the year. And as I mentioned, fixed income markets were positive. Core fixed income slightly positive, up about 0.3%, and high yield bonds up almost 3%. Looking at some of the key metrics at the bottom of the page, the US 10-year Treasury had a significant move. It has a significant move higher in the first quarter. We saw a significant move lower in the second quarter as the interest rates dropped about 0.6% they're 0.6% higher than the end of the year. They dropped by about 0.2% since the end of the first quarter. And here on the third line down, US unemployment now, as I mentioned, sub 6% at 5.9%. Looking at the market overview, this looks at the daily performance in global stocks and also in US fixed income. And you see US fixed income there at the bottom, the blue line has been very consistent over the quarter, slightly positive, not a lot of volatility. Global equities really had a great April. And then a lot of people started to get concerned, a lot of investors started to get concerned that the Federal Reserve would remove their accommodative policy sooner than what was expected. And you see kind of a 4% drop there, kind of mid-May. The Fed came out quickly afterwards, voiced their support to be patient, long-term approach with their policy, kind of remove some of the uncertainty around the removal of the accommodative policy anytime soon. And that allowed stocks to rally the rest of the quarter. Looking a little more deeper into fixed income, we break it down to the key sectors of fixed income. As I mentioned, you'll see the best performer kind of almost on a straight line up over the quarter, high yield bonds, 2.7%. And then with interest rates falling, government bonds also had a good quarter, up 1.7%.
Now we get a chance to look at the path of the 10-year Treasury rates over the quarter, one of the core drivers of fixed income returns. As we see, the 10-year lost 29 basis points over the course of the quarter. This is due to a couple factors, one of them being the high level of expectations for economic growth at the end of Q1, as well as market participants inferring that near-term overshoots in inflation due to supply shocks and reopening are transitory. This very much mirrors comments of Fed Chairman Powell, and for the time being, it seems like market participants in aggregate are actually in agreement with that. As we zoom out to a longer-term picture, though, the support through continued purchase of government and agency securities by the Fed will eventually have to taper, putting upward pressure back on rates. On the next slide, we'll get a chance to look at a more volatile relationship over the quarter. We see the change in the levels of the US dollar spot rate. So at the beginning of the quarter, the US dollar lost almost 4.5% relative to a basket of diversified developed market currencies, recovering about 3.5% of that in the last month of the quarter. This led to some additional volatility in international equities for US-based investors. However, this is another contribution to the continued downward trend on the US dollar since its previous peak in 2020. And we'll go dive a little bit more for that historical context on the US dollar a little bit later. Now, looking at all these indicators allows us to see what drives some of the underlying return and risk relationships in the market. Zooming out to what that means from a returns perspective, we see on this slide two different but related characteristics of equities. The blue bars, we have calendar year returns for the S&P 500 index, and the red dots represent the peak to trough max drawdowns during that calendar year. We notice that every couple of years, there's a correction of 10 or more percent. Every 3 to 5 years on average, there's historically been a correction of 20 or more percent. And at least once a decade, there's a recessionary crash in excess of 30%. However, in spite of these drawdowns, we see that the vast majority of times, equities are still positive. So 16 out of 20 times in the past 20 years. So far for 2021, the returns, as Nick said, pretty robust, over 10%. But the maximum drawdown has only been 4.13% so far in 2021. So this is low relative to this history that we're showing here and may indicate the need to be cautious as complacency might be taking hold. Now, that being said, the economic underpinnings are actually such that if a drawdown were to occur in line with historical averages, which is about 14%, it would be an opportunity to deploy capital at more preferential pricing versus a signal of impending economic collapse. So that being said, we're choosing our positioning within the market to not overextend portfolio risk to generate returns because we want to make sure that we are stewarding our clients' capital in the most effective way possible.
Now we're going to switch gears and look at kind of our global outlook for the markets. So this slide here, slide 11, is hopefully very familiar to all of you. This is something we show every quarter. This captures the 5+ year expected return on an annual basis for the major asset classes in the portfolio and in our opportunity set. As a reminder, these are a combination of our own internal return expectations and also those of our strategic partners, try to take out any biases in the numbers. Starting on the left, looking at the green bars, these are all the bond indices. And expected returns here have dropped slightly quarter over quarter from what we discussed in March. And that kind of correlates with the fall in interest rates. Investment grade bonds are expected to provide anywhere from 1.4 to 1.8% returns and high yield about 3.8% returns, much lower than historical return expectations. In blue in the middle, we list the major equity indices. Expected returns have dropped quarter over quarter for US stocks, but have risen for non-US stocks. Global equities are expected to return just under 6% annually going forward. Looking at the gray private market bars, These actually had a positive uptick quarter over quarter. And they also have very attractive premiums relative to their public market equivalents. For example, if you look at private credit at 8.9% expected return, by shifting some assets from core fixed income into private credit, we expect roughly about a 7% pickup in return over public core fixed income. And another example, if you look at private equity, close to 11% at 10.8%, this is expected to provide about a 5% return pickup over global public equities. We continue to due diligence new managers in the private market space to increase client private market allocations to take advantage of higher expected returns in private markets. The two horizontal lines on this chart detail the return impact of adding private markets to a public-only portfolio. The red horizontal line is a simple 70% global equity, 30% fixed income portfolio. That portfolio today is expected to return about 4.6% per year going forward. If you look at the blue horizontal line, this is the similar 70-30 portfolio, but we have 20% of private markets in this portfolio. This portfolio is expected to return over 1% higher, about 5.7% expected return going forward. So a very strong pickup in returns by switching to privates. And we don't expect the risk profile of the portfolio to change in negative fashion. On the next slide, we look at our most important model. We have 12 investment models that we follow. This one drives our overall allocations between stocks and bonds. We compare here the excess returns that we expect from US stocks relative to the risk-free rate of the 10-year Treasury bond. And that relationship is shown on the chart with that blue jagged line, and it goes back about 25 years. As the signal moves further away from the center of the chart, the stronger the signal becomes for either stocks or bonds. When the signal gets near the top of the chart, we will tilt more into stocks. When the signal gets closer to the bottom of the chart, we will stick more to bonds. You'll see with the box, the call-out box to the right side, our current signal is 0.64. This is recommending a neutral position in client portfolios to stocks and bonds. The signal needs to get over 1 for us to tilt back into stocks, or below -1 to tilt back into bonds. Over the history of the model, when the signal is neutral in this range, stocks have beaten bonds by roughly 3% per year, but with less certainty around the outcome. On the next slide, we're going to shift to look at just equities. On the previous slide, we looked at the relationship between stocks and bonds. Here we look at the relationship within stocks alone. So the chart on the left shows the trailing price to earnings ratio of US and non-US stock indices. The US is depicted by the blue solid line and has more than fully recovered from its COVID-related drop. US equity valuations continue to climb despite strong earnings and are at their highest level since the tech bubble in 2000. Typically, when valuations are this high, future returns are lower than average. The non-US indices are more attractively priced relative to their earnings and provide a higher expected return than US stocks. On the right side of the slide, we introduce a new metric to gauge the tailwinds in the economy. The Purchasing Managers Index measures the direction of economic trends in the manufacturing sector. A score above 50 signals an expansion from the previous month in 5 main areas, including new orders and inventory levels. As you see on the chart, the US, Europe, and China all show very strong month-over-month expansions, with Japan right around neutral. So the majority of the world is kind of having this manufacturing boom. We maintain a tilt to non-US equities relative to US equities, as we feel we could buy those non-US future earnings at a lower valuation than US markets. Looking at the US dollar strength one more time, kind of over a longer context, the relationship of the US dollar to foreign currency tends to rotate over long periods of time. And since 2015, the US dollar has been outperforming international currencies, also helping US stocks kind of outperform international markets. But it's kind of left it at this kind of, one standard deviation richness level. And this could provide a tailwind for non-US equities over time. This, as I mentioned earlier, this relationship tends to swing back and forth and mean revert over time. And we see some signs of that, over the last couple of years.
In this side, we see a historical time series of option-adjusted spreads for the main credit quality tiers for corporate bonds. In March of 2020, there was a sharp spike in spreads, which provided an opportunity to implement an opportunistic allocation to credit-sensitive bonds. Now, since we implemented this allocation for our clients, Spreads compressed back to near historic lows, generating significant excess returns for our clients. Now that much of that performance from spread compression is in the rear view window, we're looking to take down some of that exposure. We think of our bond allocations holistically as a mix of interest rate and credit sensitivities, and we've been working diligently, as Nick said, to implement a more efficient strategy to generate income and mitigate much of the traditional fixed income risks, which are magnified by heightened valuations and low credit spreads in public fixed income. But one of those key solutions that we've implemented for our clients to replace core public fixed income as a portion of portfolios is Variant Alternative Income Fund. So Variant is a private market strategy structured as an interval fund. It's an extremely diversified strategy with low correlations not only to equities, but also other fixed income asset classes. It also allows our clients to generate almost 3 times the yield of investment grade bonds with limited interest rate sensitivity and diversified non-corporate risk profiles, It's significantly outperformed all major fixed income asset classes year to date with increased yield and lower volatility. Its risk profile is such that it can play a role as a core diversifier, reducing portfolio risk and generating significant income. The strategy is also rate insensitive, meaning that the structure of the loans mitigates much of the risks of rising rates on the portfolio. We've implemented several other strategies that include some type of protection for rising rates, such as SRLN and Blackstone REIT, which we've spoken about on previous webcasts as well. So rounding out the last few slides of the presentation, I want to take some time to look at where we sit with regards to the impacts of economic recovery from the COVID pandemic. So first, looking at the core personal consumption expenditure data, which is sort of the key metric for inflation that the Fed follows, we see a near-term overshoot in the data for May, a spike in inflation, if you will. So much of this is due to supply-side shocks, as well as what we call base effects from these numbers being a year-over-year comparison to the lows of the pandemic in 2020. The Federal Reserve has reiterated several times its belief that these effects are transitory and will normalize over a reasonable time frame. We tend to believe that over the longer term, these overshoots of these short-term implications will be overcome by longer-term deflationary forces of demographics and technological innovation. But over shorter horizons, inflation overshoots such as this create volatility and uncertainty in the path of rates and Fed intervention. For inflation to be sustained above the Fed's target, we would need to see certain structural changes in indicators such as labor market slack decreasing. We'll actually take a look at that on the next slide. Looking at the unemployment rate, we see that the economy has come a long way since the depths of COVID. The unemployment rate is currently under 6%, as Nick said earlier, but still a few percentage points away from pre-crisis levels. Looking at historical unemployment data over a long period of time, we would expect the decrease in unemployment, it could actually take a couple of years to get to pre-crisis levels. The current levels are still a bit higher than what we would consider full employment, and therefore the pressures on wage growth and push-oriented inflation forces are not a significant near-term risk. Last key piece we're going to look at for these indicators here is a marker for pent-up demand. So there's a significant amount of cash sitting on the sidelines waiting to be deployed, just shy of about $5.1 trillion. It spiked significantly during COVID. It came off the sidelines to generate some significant returns from the bottom and in the recovery phase of the last part of 2020. With historic fiscal spending reaching more and more of our citizens, they are waiting to deploy that capital into markets. We think that this is a potential tailwind that could speak to the current equity bull phase having some room to run still. So we covered a lot of topics today. Again, we'll be recording this video to redistribute, but I want to turn it over to Kurt for a firm update and some housekeeping items.
Great, thanks, Matt. Once again, I want to thank everybody for taking time from their schedule today. I know you're all very busy. Kind of firm update. We had an extremely strong first half of the year in terms of new business relationships and growth of the firm. We've increased assets under management about 40% already this calendar year through a number of new relationships. We're very proud of that, and the team is working hard, and we're in active dialogue with a number of other interesting opportunities right now. We mentioned to you in our last webcast that we had started doing due diligence on identifying a new reporting and kind of portfolio management platform for the firm. There's 11 firms that were originally evaluated. We did select a firm called Orion. We've already started to do the transition with them, which we're very excited about. And in the fourth quarter, we'll be opening a new kind of client, excuse me, a client portal. So you'll be able to access your account information online through this Orion portal and have all of our information along with the direct downloads from the custodian. And then I think I'll finish with that we continue to look at new private asset opportunities. In fact, earlier today, Matt, Nick, and I were on a webcast with a firm that has we think a pretty exciting opportunity, but there are several more that we are going to be in active dialogue with at the end of this month. So we continue to look for new and exciting opportunities to balance out the core liquid piece. So with that, I'm going to finish. We look forward to discussing your individual portfolios with you. The second quarter reviews, we'll be emailing those out and then scheduling either Zoomcasts or individual meetings with all of you. So thanks again for the trust and confidence in our firm. Have a great summer. As always, please contact us if you have any questions. Thanks again.